This video provides an overview of the U.S. Federal Reserve System, better known as the Fed. Now, this first graphic here is taken from the Federal Reserve website, federalreserve.org. This is a screenshot of the purposes and functions section of the website. So if you were to go to their website, go to this particular page, and you could click on each of these seven little boxes here. You get an overview of each of these sections of the Fed. So you get an overview of the Fed, the key system entities, monetary policy, fiscal stability, etc. And I bring that up because most of the graphics and charts that are included in this presentation have been taken from the material kind of behind the scenes on the Fed website. What I'm trying to do with this video is present the information kind of in a concise and coherent manner so you can follow through the process of the Fed, process and structure of the Fed. So what is the Fed? Well, the Fed is the central bank of the United States. What's a central bank? Well, a central bank in most countries has two roles. First off, it's the bank that handles the government's money, so your tax deposits and things like that are on deposit, that have been paid to the government that they haven't spent yet, are placed in their bank accounts, and for a bank, they use the Federal Reserve Bank. It's also the banker's bank, and what that means is it's a lender of last resort to banks. So instead of having bank runs like we experienced in the 1930s, when a bank sort of ran out of money, was solvent, but otherwise ran out of money due to a bank run, today they would call up the Fed and get the money from the Fed. So when you need money, you go to the bank. When a bank needs money, it goes to the Fed. Now, kind of in true government fashion, the Fed is not just one entity, but it consists of 12 different regional banks and a central office in Washington. And here we have the diagram of the map of the United States showing the different offices. So there's a Fed in Boston that handles New England. There's a Fed in New York that handles New York. There's a Fed in Philadelphia that handles Pennsylvania, New Jersey, and Pennsylvania and Delaware and things. There's a Fed in San Francisco that handles the western states, etc. So there's 12 independently operated Federal Reserve branches, and they're operated within the constraints of the Federal Reserve System as defined by kind of the act of Congress that established the Federal Reserve System and the supervision of the main bank in Washington. Now, how's the Fed managed? Well, the Fed is structured and exists under the Federal Reserve Act of 1913, which is the act that created the Fed. It's nominally supervised by the president with approval of different board members by the Senate. So, but it's governed by this three-tier structure: a board of governors, the Federal Reserve banks themselves, and the Federal Open Market Commission. So, the board of governors. This is a 7-member board. The members of the board are set the guiding principles and the guiding rules for the Fed. Now, the members of the Board of Governors are nominated by the President and approved by the Senate, just like traditional cabinet positions, if you will. But the Fed is also supposed to be a quasi-independent agency, independent of political influence. So the 12 Federal Reserve banks operate independently of the central Fed in Washington. And each of those Feds, local banks are members of their local Federal Reserve Bank. So if you're a bank in California, you're a member of the San Francisco Fed, and you get to elect members of the Board of Governors, Board of Directors of that Federal Reserve Bank in San Francisco, or the Federal Reserve Bank in Chicago, or the Federal Reserve Bank in Dallas or Kansas City, or wherever the district your particular bank is located in. So there are 12 independent Federal Reserve banks have their own Board of Directors. And finally, there's this other entity over here called the Federal Open Market Committee. I'll talk about that on the next slide. So what's the Federal Open Market Committee? Well, the Federal Open Market Committee is this composite committee within the Fed that makes the key interest rate and monetary policy decisions. So who's on the Fed Open Market Committee? Well, first off, it's the 7-member Board of Governors. So the 7 people the President nominated that were approved by the Senate, they're members of the Federal Open Market Committee. The president of the Federal Reserve Bank of New York is a permanent member of the the Fed Open Market Committee, and that's because New York is sort of, at the time they established the Fed, and I think still is the financial capital of the United States. So the Federal Reserve Bank of New York president has a little bit more influence than some of the other districts. So he or she serves as the president, as a member of this committee. And finally, there are 12 Federal Reserve banks. 5 of those bank presidents from those Federal Reserve banks on a rotating basis get to be on the Federal Open Market Committee as well. So we get the 7 Board of Governors, the five bankers, plus the president of the Federal Reserve Bank of New York. So we've got this committee, the Federal Open Market Committee, and they're the group that makes the key interest rate and monetary policy decisions. So if you will, some of these people are appointed by the president, some of these people are elected by the member banks. So it's sort of a collaborative body. So now, of course, the question you're probably wondering is, what does the Fed do? Well, the Fed has 5 key functions. Talk about them in reverse order here. They promote consumer protection and community development. So in this role, the Fed is really setting the rules and standards that protect you and your bank accounts. They set the rules on how banks are supposed to process transactions. They set the, if you've ever been asked for your bank routing number or your checking account number, but particularly your routing number when you've set up electronic banking. Yeah, this is part of the Fed's role, is to set up those routing numbers so we know which bank is which and things like that. So it's kind of a rules and standards body. Some of the Feds are a little bit involved in some community development activities, but the prime role here is the rules and standards. Well, what else do they do? Well, they foster the payment and settlement system safely and efficiently. So if you've ever wondered how your check gets cleared, someone writes a check and you receive a check from somebody in San Francisco and you're living in Connecticut. You receive this check, you take this check from San Francisco down to the bank, they deposit it to your account, and somehow or other that check the money is then transferred from the issuer's account, the person who gave you the check's account in San Francisco someplace. And how does that take place? Well, that takes place through this payment and settlement processing system. And this is really one of the prime reasons the Fed was set up, to allow checks and money to clear efficiently throughout the country. So it just didn't clear within the same city or within the same region, but to allow it to clear efficiently throughout the country. So one of the Fed's roles is to oversee this check processing and financial transactions system. They want to make sure that the money in the country can be transferred efficiently, kind of from coast to coast or wherever it needs to be. Now, another role of the Fed is they supervise and regulate the financial institutions. I mentioned on the earlier slide that the Fed is the bank's bank, which means it is a lender of last resort. If a bank needs money to prevent a bank run or needs money in an emergency situation, they come to the Fed. Well, part of the Fed's role there says, well, if we're going to loan you money in an emergency situation, we're also going to examine you. We're going to examine your financial statements. We're going to set standards for what your assets are. We're going to establish standards for adequacy. We're going to audit you for compliance. Basically, their role here is to make sure the bank doesn't go out of business, to make sure the bank's being operated soundly, has sufficient assets, it's being operated in a prudent and fiscally responsible manner. That's the role of the Fed. That was one of the other primary reasons the Fed was set up, to make sure the banks are being operated properly. And from the Fed's perspective, if we're going to loan you money in an emergency, we really need to make sure your assets are good and everything's been done properly. We've examined you. We know what's going on. So those are sort of the administrative roles of the Fed. Now, the Fed also has these other 2 dubious roles. I'll talk about the second one here, helping maintain the stability of the financial system. And I'll talk about the monetary policy in the next couple slides. But the Fed's role here is to make sure the financial system in this country works to support a stable economy. This means a lot of things, and it's sort of nebulous exactly what the Fed has to do to make this happen. But in general, it wants to make sure loans are available for businesses and customers. If businesses can't borrow, they can't expand. If customers can't borrow, they can't make major purchases, homes, cars, that type of thing. They also want to make sure that the banks collectively are not taking too much risk. And they also want to make sure that consumers are not taking too much risk. So they sort of monitor the risks that the banks and the consumers are taking. During the Great Recession in 2008, 2009, one of the things that was discovered that in a lot of cases the banks were taking too much risk. So the Fed, while they have this responsibility for making sure banks are not taking too much risk, they sort of missed a few elements here in the Great Recession. So their job was to do that. They did it, but they probably didn't do the job very well. And really, the final part about this is to make sure money is available in the system. And this means to make sure you can go down to the bank and cash your check and get money. You can go to the ATM machine. The ATM machine will work and will actually disperse the money you've asked for. Because if you can't get money out of the bank, your money's in the bank, but you're not able to get it out or something like that, the system's not working well. So the Fed's responsible for making sure that takes place. They're very good at the technical details of this. As I just mentioned, they too miss some of the risk associated with the housing market during the recent financial crisis, Great Recession. And the final role of the Fed is conducting the nation's monetary policy. And this is really a key role. So the Fed has this mandate from Congress to do primarily three things. Outside of their administrative roles in regulating the banks and things, they're trying to assure maximum employment for the economy, which means they're trying to make sure unemployment is as low as possible. They're trying to assure stable prices, which means that we don't have runaway inflation like we might have had in the 1970s and things like that. So they want to keep unemployment low. They want to keep inflation and prices under control. And they really want moderate long-term interest rates. We don't want very high interest rates. We don't want very low interest rates. We need normal interest rates in the system. And the Fed uses monetary policy to try to influence these elements in the economy. And when I say the Fed, who's conducting the monetary policy? This is where the Federal Open Market Committee comes in. This is the members of the Board of Governors, the New York Fed president, and these rotate and 5 of the other 11 Federal Reserve Bank presidents. These are the folks that are sitting together, having a meeting, trying to control and influence these factors in the economy. So what tools does the Fed use to conduct monetary policy? And there's 5 listed on their website. They can be very technical. This is kind of a brief overview of them. So the first 3 here in green are the traditional tools of the Fed, as they call them on their website. And these tools are designed to influence the amount of money the banks have available to make loans. So the concept is, if the banks have lots of money available to make loans, they'll make lots of loans and they'll lower interest rates. If the banks have limited amount of money available to make loans, they'll make fewer loans and they'll be able to charge higher interest rates. So if we want the economy to expand, we influence the banks to make a lot of loans. Everybody borrows money. Businesses invest in new factories and things. Consumers invest in, purchasing homes, cars, that type, washing machines, that type of thing. So that's the goal of this. The Fed is trying to influence the amount of money that flows into the system. And they do this with 3 different ways. The first way they do it is with something called open market operations. It's kind of a fancy name. It says they're trying to influence the supply of balances in the federal funds market, supply of money, and the supply of credit and economy. What the Fed is basically doing here is buying and selling government securities in the market. And in doing so, they're competing with the banks for government securities. So the bank is sitting there and they have 2 choices to invest their money. They could, you deposit money in a bank, they have to invest it someplace. So they can either invest it in government securities, which are nice and safe, or they can loan it out. And their decision to invest in government securities depends on a couple things. It depends on what kind of interest rate they can get if they loan it to people. And it depends on what kind of interest rate they can get on the government securities if they buy them. And it's easier to buy government securities than it is to loan the money to you. So that's sort of the bank's preferred route. So what the Fed does is, in open market operations, they buy and sell government securities. So they try to buy and sell lots of government securities. So what they do is they buy, if they want to influence the rates, they buy all the government securities in the market, so the bank can't buy any. So the bank says, well, I can't buy any government securities. My next choice is to loan money to consumers. So then if the Fed buys all the government securities available, a whole bunch of them, the banks are forced to loan to consumers. If the bank says, well, the economy is kind of going too fast, we'd like to slow down what consumers are doing. We'd like to raise interest rates, get consumers to spend less. They sell lots of government securities. The bank have lots of them available. They don't have to loan to the consumers anymore. Consumer loans, interest rates go up, consumer loans sort of dry up. So that's the first way they do this. They influence the market by influencing what the banks can do. They also do that with reserve requirements. When you make a deposit in a bank, the bank is required to keep a certain percentage of that money on reserve in case you come in the bank and want your money back. Now, not everybody wants their money back all at one time, so the bank will loan out the rest of the money. So the Fed, by manipulating reserve requirements and making them 5%, 10%, 15%, 3%, something like that, is able to influence the amount of money the bank has available to lend. If they raise reserve requirements, the bank can lend less money. If they lower the reserve requirements, the bank can lend more money. And again, the more money the bank has available, the more active or non-active you are in the economy. And finally, they also control the discount window lending, and this influences the supply balances on federal funds and again, a supply of money. The idea is when a bank has money sitting with it, what does the bank do with it? What do you do with extra money when you have it? Well, conceptually, you put it in the bank to earn interest. Well, banks do the same thing. And banks do the same thing, but they deposit their money with the Fed. And their decision whether they're going to loan out that money or keep it and try to earn interest in the Fed depends on the interest rates the Fed's paying, which is through the discount rate window. So what happens is if the Fed's paying a relatively high rate of interest at the discount window, the banks all leave their money on deposit with the Fed and don't loan it to you. If the Fed lowers those rates there, the banks say, oops, I need to get some interest rates, I need to earn some money, so let me take and loan that money out to consumers. So in each of these ways here, and the ones in green, the Fed is trying to influence the bank to either make more loans if they want to grow the economy or come out of a recession, or make fewer loans if they want to kind of restrict inflation. If unemployment is very low, inflation is starting to take place. So the bank is able to, the Fed is able to influence the bank to say make loans, don't make loans, and influence the interest rates there. Now the next two items here are sort of what they call the non-traditional tools. The first one is called forward guidance. And the explanation here is sort of cryptic in government language, but it helps the public understand policymakers' intentions about the future course of monetary policy. So what the Fed is basically saying, and you see this in the paper a lot now, well, we're going to raise interest rates in a few months. So by influencing interest, by saying things like that, they're trying to influence decisions in the financial markets. They're trying to say to people, well, the Fed's going to raise interest rates in a few months. We better borrow money now because the interest rates will be higher later. Or the Fed says, I'm going to lower interest rates in a few months. People say, oh, I better hold off on my spending until the Fed lowers interest rates. So basically with forward guidance, the Fed is trying to influence the thinking of the traders on Wall Street and the thinking of what corporations do, primarily corporations, but sometimes individuals, in terms of when they're going to borrow, how they're going to spend their money. And the last one here is large-scale asset purchases. And this is something that had come out of the 2008 recession. Quantitative easing is an example of large-scale asset purchases. And basically what happens here is after the recession, a lot of the banks their assets weren't that good. They had a lot of bad kind of home loans on there, loans that weren't worth, the house wasn't worth what the borrower had paid for it, the house wasn't worth what the amount that was loaned on it. So the banks had these assets that weren't worth 100% of their value. They were worth something less. If they had to foreclose, they had $200,000 loan, they'd be getting $175,000 or something. So the Fed and banks were therefore afraid to make additional loans because they didn't have enough capital to do the work. They didn't have enough money in case things went wrong. So part of the large-scale asset purchase program in quantitative easing was to inject capital into the banks so the banks could continue lending. So what the Fed did in this case, in this non-traditional tool, kind of one-time program that they've run a series of times over the last 8 to 10 years in terms of the financial, trying to bail us out of the Great Recession of 2008, was they would purchase these assets from the banks and sort of help to recapitalize the banks, help put the banks in a position where their bad assets were sold, and they were now in a position to, again, lend and stimulate the economy. If the banks had all these bad assets, they weren't going to lend. They weren't going to lend, the economy wasn't going to grow. If the economy didn't grow, we weren't getting out of the recession. But if we recapitalized the banks, kind of took their bad assets away, gave them additional capital, they were in a position to lend. They could lend, businesses could invest, consumers could buy, and we could work our way out of the recession. So these are the primary tools the Fed uses for monetary policy. The green ones are sort of the more traditional ones. The yellow ones are sort of the newer ones, or the non-traditional tools, as the Fed calls them. And this is really the summary. So at the top of the pyramid here, we have the U.S. Central Bank, the Federal Reserve System. Below that, we have the entities that control the Fed. There's this Board of Governors appointed by the President. There's these 12 Federal Reserve banks scattered throughout the country who are quasi-independent but still have to report to the Federal Reserve System, who elect their own directors. And then there's this Federal Open Market Committee who does a lot of the, monetary policy work, where the membership comes from the Board of Governors and the 12 Reserve banks. And as we just talked about, there's the 5 functions of the Fed. They conduct monetary policy. They're responsible for the stability of the financial system. They're responsible for supervising and regulating the banks. They're responsible for making sure the payment systems work, and they're making sure that consumer protection is in place throughout the system. So that's the quick summary of the Fed.